It is Sunday night, March 15th, 2026. Across the globe, financial markets sit in suspended animation, bracing for a brutal Monday open. The panic stems directly from the Gulf. Iran's Revolutionary Guard has confirmed active, ongoing naval drills that amount to a strict maritime blockade. This halts physical crude transit through one of the world's most critical maritime corridors. The market has immediately priced in a permanent $20 war premium, pushing Brent crude aggressively past the $100 a barrel mark. This creates what analysts call a stagflationary pincer, a scenario where slowing economic growth collides with rapidly rising inflation. Central banks are trapped. They cannot cut interest rates to save falling equities, because doing so would pour fuel on this new surge of energy-driven inflation. The market's previous assumptions have dissolved. Institutional capital is now undergoing a mandatory reallocation that will define the session ahead. We are watching the great unwind unfold in real time. Smart money is aggressively liquidating its exposure to growth equities and tech proxies globally. In the United States, the S&P 500 has suffered a severe technical breakdown. The index crashed straight through its critical 100-day moving average, closing out Friday at 6,672. The S&P 500 breaks below structural support at 6,780, squeezed by inversely rising $100 oil, triggering systemic selling that erodes profit margins. Shifting to the global VIX volatility index, spiking to 27.29, traders are pricing in a 45% probability of a U.S. recession. The panic is equally severe in Asia, catching the Bank of Japan in a policy trap. They need to tighten interest rates to support a collapsing yen, but making borrowing more expensive right now would crash an already fragile Nikkei index. Meanwhile, Europe's leading benchmark, the DAX, is facing a severe structural re-rating. Germany's economic core relies on heavy manufacturing, a factor that is hypersensitive to the price of imported natural gas and crude. Even crypto assets are failing to provide cover. Bitcoin is shedding liquidity rapidly, behaving like a high-beta tech stock, meaning its price swings are tied to the broader market's risk appetite, rather than a geopolitical safe haven. Traditional growth and tech portfolios are being abandoned. Billions of dollars are currently in active transit, seeking immediate shelter before the Monday bell rings. All that liquidated capital is rapidly pooling into a few distinct, isolated havens, desperately seeking shelter from the impending market storm. First, there is an immediate flight to fiat safety. The US dollar index surged to 99.64 as global supply chains fragment and investors seek the deepest pool of liquidity available. Capital is also fleeing the threat of equity devaluation by piling into precious metals. Physical gold has broken past the $5,150 threshold, driven by a bid for tangible, real value that central banks cannot print. But the most striking move is in the Middle East. We are seeing a geographic divergence, with the Saudi TASI index acting as a rare global equity winner, absorbing intense institutional inflows. Companies like Saudi Aramco and SABIC act as geographic hedges. The energy supply shock straining the global economy is simultaneously boosting the kingdom's fiscal surpluses through record-high export revenues. In a severe stagflationary crisis, absolute proximity to secure physical energy production replaces standard tech growth as the primary portfolio shield. Looking ahead to the Monday open, the weekend shadow markets are pricing in a gap-down open, where prices instantly begin trading lower than Friday's close for all Asian and Indian indices. India is uniquely vulnerable in this scenario. The country imports 85. That math forces the rupee down to 92.34 as the national import bill skyrockets. The singular macroeconomic event that will dictate whether Monday's sell-off turns into a total market collapse happens at exactly 7:30 a.m. with the release of China's industrial production data. This diagram shows the high-stakes binary outcome the market faces. We have the heavy weight of $100 oil on one side, balanced against a fragile 5.2% Chinese growth forecast on the other. If China misses that target, the Asian growth engine stalls at the exact moment the energy shock hits, triggering a limit down scenario. A market drop so rapid that trading is automatically halted. For professional managers, the survival strategy for the week is strict. Reduce position sizing. Hold absolute cash or short-duration treasuries.
and avoid highly cyclical sectors like financials and autos until the energy squeeze eases.
Surviving the Hormuz standoff requires abandoning outdated assumptions about market growth and executing a defensive liquidity rotation as the new reality settles in.